Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, here we are. Another Friday, Jim, and it's been an interesting week in the markets. I just wished I knew what was going to happen next week.
It sure has been interesting.
Give me next week's headlines, okay?
Well, we have some listener questions to look at first. The first one comes from our friend Bert Weckenbach. He says, hello, Bob and Jim. When it comes to foreign currencies, everyone's looking to the U.S. dollar and the rise that has started against almost all the other currencies, but the Swiss franc is holding up very well against the dollar and seems to be just as strong. What's going on here? A flight to safety? And what will happen to the franc if the expected credit contraction starts in earnest?
Yeah, Bert, thanks for the question. Yeah, you're right on the U.S. dollar. The DX has rallied up to 96, and our target now is about 103. And if it gets to 103 and beyond, then I think our target becomes about 120. So it's going to be one of those moves in the U.S. dollar, which is contrary to what the street's saying. Everybody's talking about the dollar's going to crash and disappear, and inflation in the U.S. is going to go to the moon and all that kind of stuff, which we don't go with. But the Swiss franc, and ages ago we called it the Swissy. When it used to have a certain backing by gold, it was popular. That's a unique country with a unique financial situation, and it'll probably do okay. I'm not really following it that closely, but it is a good thing to bring forward that the strength in the U.S. dollar will likely be due to the fact that a good portion of the debt bubble, of the debt that's been issued in the bubble, is due and payable in U.S. dollars. So once the boom is over, and this is not my imagination, it's followed previous great financial manias, then the compulsion becomes to service that debt burden. And how do you do that? Well, you send U.S. dollars to New York City to meet your obligations. And so in effect, the huge debt bubble is a huge short position of U.S. dollars. Prior to the 1920s, London was the financial center, and sterling was the senior currency, and the pattern was the same going all the way back to the early 1700s. So what I'm talking about is nothing new. It's the way currencies go following a great financial mania.
Question from Kathleen, and I predict there will be a musical reference in it because she loves to connect music and finances.
Yeah. From
Kathleen. Hi, Jim and Bob. It seems we did see the beginnings of a sell-off in November. The gales of November, like in Canadian Gordon Lightfoot's song, The Edmund Fitzgerald, did arrive, although later than it did in the song. Bob, can we expect a Christmas rally, or will December be a bad month for the markets and for sailing on Lake Superior?
Well, there we go, Kathleen. Yes, a compelling song, The Edmund Fitzgerald, and a dreadful accident. But I'm going to really step out on a limb here, Jim, and I'm going to say it's going to be a typical Christmas. If it's a rally, it'll be called the Santa Claus Rally Typical. And if it doesn't rally, it will be typical Christmas doldrums. But then you also got the interest of the establishment, all the major brokers, where it's bonus season, and so they're going to try and keep the markets as happy as possible. But the stock market and some key commodities such as crude oil and credit spreads have all had a whack that has been quite important. So, yeah.
We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, for several months, the U.S. Fed has said this inflation is just transitory. It'll disappear in a flash. But Jerome Powell has now said, just the other day, looks like this inflation's going to be around for a while. How come their crystal ball was so foggy?
Well, that's the problem. The Federal Reserve is using computer models to try and forecast what's going on, and they don't work. The thing that if one becomes a financial historian, and then you study how each financial bubble works, then you get an idea of how history puts itself together. And to me, and I've mentioned this before, that we are in the greatest inflation in financial assets in history. Now, as each of these great bubbles, the first one was the South Sea bubble in 1720, and 1929 was the fifth, and this is now the sixth. Each of these bubbles end up with a terrific speculative surge. And you also have a business boom with this, so naturally commodities, industrial commodities firm up, and they have. But what happened here with the change in the U.S. administration from a pro-business administration to anti-business Marxist administration is that all of the old inflation bugs got antsy about this and said, okay, mind you, and an inflation bug calls for inflation all the time. It's the only thing they understand, that the Fed is evil and can depreciate the currency at will, and therefore prices are going to go up. So they've been really on the bandwagon, but no, I'm staying with the way financial history works. The rise in industrial commodity prices has been selective. You had a certain group rallied in the first half of the year, and then you had yet another, so it was a rotation then into, aluminum, uranium, and what else? And palm oil, various things, and then some of the exotics. So, but it's one by one of these things suddenly shoot up, and the CRB index has become as the most overbought since back in 2008. So the point that we're making is that when you're in a great financial mania, things do what they do. Now, one of them is copper's real price, adjusted for inflation, going up, and it has. The other is the U.S. dollar purchasing power slacking for a bit and then turning up. Now, this is really interesting because the dollar has turned up. Real interest rates go down in the bubble, and then they turn up. Now, if you look at junk bond yield in China, it's up to 28% nominal. And real, I haven't looked at the adjusted for it, but hey, in China, junk bond yields are going up. So what we see is the identifying features of previous great financial manias. And they are in line through the last year and a half, and now they're beginning to change. So what do you get when you look at financial history? You say that when the game is in financial assets, and it's always followed not by around a decade of inflation in CPI and in commodities, been followed by deflation of most asset prices every time. So this is where we're watching for the failures in here. Now, one of the other things you get with a boom is that credit spreads narrow because of confidence, so people are reaching for risk, and then they change. Now, they have broken down recently. The credit spreads have changed. Enough to get our attention, but not yet dramatic. So the break in the market recently included, in the credit markets, included some key commodities such as crude oil, as well as the stock market. Now, some of these items, including the stock market, have taken out key support levels, and further erosion is possible. So, but what I want to do is Jim, is get across just how hyperinflation, the inflation in financial assets has been. The German 10-year note, for example, got down to a minus interest rates, a minus on the nominal, and in the whole history of interest rates, that's never happened before. And then if you look at the cryptocurrencies and the Bitcoin action for big cap stuff, the percent gains have never been, these are magnitudes greater. Like the big deal in 1720 was the South Sea Company, a quasi-government company that was helping to retire debt, and it was a 10-timer from, say, went from 100 pounds to 1,000 pounds, and then back all the way down to 100 pounds. So, where certain people who have not studied the financial markets are quite adamant that our 1970s inflation is coming back, haven't studied financial history. And the 2 points I've used to illustrate show that that in these 2 sectors, it's not just been inflation in financial assets, it's been hyperinflation in financial assets. So once this fails, we're staying with history that most asset classes will deflate in price, and those that are calling for a 1970s type of inflation just haven't done enough research.
Another headline that caught your attention, U.S. inflation pressures grow further. I think we've been discussing that, but when we have this kind of inflation, usually the reaction to slow it down is to up interest rates. And I listened to commentators on Bloomberg saying they expect 2, maybe 3 hikes in the U.S. next year if they dare to. And in Canada, we could see up to 5.
Yeah, that's one way of going about it, Jim. But I think what you have here is that there's a certain distortion in the financial markets, with the Treasury bill rate being close to 0 and the Fed funds rate being 0.25. I mean, it's close to 0. So what typically in a business cycle, you get those short rates, T-bills and Fed rates, going up in the boom and then down in the bust. So the T-bill rate is likely to go to 0 in the next contraction. The Fed will likely go down, stay down low with that, but I don't see short rates going up. But longer rates have already, like for junk, and particularly junk in China, are already heading up. So in a financial bubble, typically high-risk interest rates really go up. It's Mother Nature's way of treating the excesses, otherwise called a new financial era. So the trend has already changed for the risk stuff to be rising in yields, and that can continue. And at some point, it could even raise the long Treasury rates, or in Canada, long Government of Canada bonds. So this is going to be quite selective. Now these guys are calling. The big guys in the States are calling for increases in the Fed rate, and that's on the assumption that the business boom is going to continue and that inflation is going to continue up. I would argue otherwise, that the markets are beginning to break down, and with that happening, short rates will stay low, and long rates could eventually go up. And the Fed, whatever the Fed does, isn't going to change things too much at all.
Mm-hmm. Now, Turkey's central bank took extraordinary measures to prop up the lira. How did that work out?
Yeah, Jim, I read that story, and of course, when a lesser country such as Turkey, and their problems were first announced in March, their central bank runs out of reserves, and so what happens is their currency weakens, and their short rates go up, and so and of course there's been some protests, maybe even some riots by ordinary folk in Turkey when they see these dislocations going on, and they've been protesting it. So then the president, I guess, talked to the central bank and said fix things, so they tried to lower rates and probably tried to hold the currency, the lira, but it's not going to work. You've had a progress whereby in March you had Turkey and Argentina announce that they had local financial problems, and at the end of previous bubbles, these problems are discovered in outlying countries, and you've got a real ongoing problem in credit markets in China, and then eventually they hit the senior markets such as London and New York. And there's a wonderful quotation from the Roman writer 2,000 years ago, Cicero, who pointed out, and I can't quote it exactly, but what he pointed out is that if there was a financial crisis in the eastern provinces, meaning eastern end of the Mediterranean, Phoenicia, and places like that, if there was a financial problem there, it would eventually hit the financial center in Rome. So this phenomenon of, at the end of a great speculative bubble, problems being discovered in lesser countries first, and then eventually the problems hit the senior financial center, it's very old. It's been happening for 2,000 years. So it'll be interesting to see how this continues.
Bob, thank you so much for chatting with us.
Yeah, Jim, thanks a lot, and we'll look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, he'll gladly answer them if you send them to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.